Moving on to the investment plan for the active investor. So, with the investment plan, very briefly, for the inactive investor done, what about the active investor? This course was initially set up for beginners, and being beginners, you might have very limited experience with the stock market. I know for myself, when I first started investing at 15 years of age, I used some of my birthday savings, which amounted to $500 or so. Needless to say, I learned that I needed to educate myself more before I could confidently invest larger sums of money. My initial investment went from $500 to about $400, a 20% decline over a 1.5 year period. But this was partially because the fees I was using on my trading platform were very high relative to the sum of money I invested. The trading platforms I mentioned earlier in this course are perfect for starting off small, as they have no monthly fees, with the exception of Acorns Investing. Please learn from my mistakes. Anyway, as beginners, I recommend you do the same. Take a small amount of money that, if you lost it, you would equate it to the purchase of a fancy dinner for your family. Give yourself a year or two of applying the teachings in this course, researching further, and reading those books upon which this course is based in order to better your chances. I'm always on this platform, and I'm willing to answer any questions you may have regarding this subjective topic, but I do recommend you invest for a minimum of 2 years before you decide to allocate a substantial amount of your wealth to an active investment portfolio. Remember, this is a beginner course, and now that you have a good foundation and a better understanding of value investing, you can start to build your experience on top of that. Once you have this experience, you need to once again consider the stability of your job and profession, the cash inflow it provides versus the cash outflows you currently incur in order to get by in your day-to-day life, as well as any large future purchases you expect to make. And also just remember to always set aside a portion for a rainy day. This is just common sense. Don't place your entire salary into the stock market, as you will need to budget for future expenses. That is also just another very logical thing. You may be interested how I currently invest my money, so I think it would be valuable to share my brief story. When I got my first job, I took all the money I had saved up over the years and placed it into a money market account in the bank. A money market fund is a fund which invests in highly liquid short-term debt instruments, such as government bonds and treasury bills, and is one of the safest investments you can make, but at the same time maximizes the interest you earn. I don't plan on touching it unless that rainy day comes. Then I take my salary and calculate the percentage of it I could invest every month into stocks after paying all of my day-to-day expenses. The amount I had available to invest in stocks is then split 75% into a low-cost index fund and 25% into an active stock-picking portfolio. I had security in that all my savings prior to my first job were placed in a money market account with my bank. I then had the majority of my salary savings go into a low-cost index tracker, which has historically proved to be a phenomenal long-term investment. That left me with a portion that allowed me to truly test my value investing skills, so to speak. My plan is to over time increase the weighting of my active stock picking portfolio depending on its performance relative to the market index. This is the most rational decision I can make. There is an age-old rule that you take your age and minus it from 100, and that tells you what percentage of your portfolio should be invested into stocks. But everyone's circumstances are different. That is my plan going forward. Back to you. I recommend any beginner to select a diverse mix of stocks, say 20 to 25 companies, if you want to construct a safe portfolio. This is just to ensure that your portfolio is adequately diversified in order to avoid any extremely volatile movements in the value of your investments. You may ask yourself, how often should I reassess my portfolio? I recommend it once every 3 months. This is just a personal guide. In addition, you may want to know when you should sell your shares. You sell your shares when the reason you bought the share no longer exists, i.e. you buy a share because it is undervalued. Once the market realizes this company is undervalued and bids up the price of the security, you need to sell it, because then the security is no longer undervalued. Your reason for initially buying the share no longer exists. As this course is targeted for beginners, I do recommend that you spend additional time and money educating yourself about the stock market and how it works. The best place to start would be to read the following books, upon which this course is based. In addition, I have attached a useful resource in this lecture. I recommend you give it a read if you consider yourself an enterprising value investor. It talks about a very specific type of value investment known as the bargain issue, or as Warren Buffett would call it, the cigar butt. As part of my honors thesis, I was very interested in the performance of these shares, as Warren Buffett had invested into them heavily when he was younger and was able to generate a significant return on his investment. Give it a read, and I will be glad to answer any of your questions on it.